Good morning everyone and welcome back to Morning Markets here at True Potential on Wednesday the 6th of March. I'm Kevin Kidney and today we're going to focus in on global volatility. It's not being immediately obvious, but volatility has declined substantially since the end of the year, and we're going to build into that for you and illustrate why that's happened. So lower realised volatility is feeding into lower expectations for future volatility, and this is key for asset prices. Broadening expectations for lower volatility is helping asset prices rise. So too is the fall in correlation between bond prices and equity prices. Since the end of 2023, this correlation has collapsed towards zero, and that is, there's no relationship day on day between the moves in equities and bonds, and this is particularly key for multi-asset portfolios. And yesterday is a classic example. Equity prices fell in some indices, but bond prices rose materially, offsetting much of the decline in equity prices. Now, lower volatility and lower correlation is the exact opposite of what we saw in 2022, when we saw correlation spike because of inflation surprises and market worries about future interest rate hikes. And this led to a drawdown in multi-asset portfolios as the prices of both bonds and equities fell. Well, we have the opposite outcomes today. Markets are no longer worried about inflation. They remain quite comfortable that inflation can decline further and remain around 2%, but the focus this year has really been on growth and expectations that growth can remain firm in the US, but also surprise to the upside, albeit modestly, in places like the UK and the Eurozone. We're expecting some form of tax stimulus from the UK budget today, but we also had rumours of further fiscal stimulus from Germany towards the end of last week. And that, at the margins, is supportive for growth. So, as correlations decline, it helps asset prices rise in multi-asset portfolios. And yesterday, in survey data, is a classic example of non-inflationary growth. The US ISM services measure for February reversed much of the spike from January, and that was caused by a falling back of expectations for future prices. The sub-measures for prices and for employment both declined, whilst subcomponents for both future business and new orders rose. That's the perfect illustration of non-inflationary growth. The inflation components, being employment and prices, are falling back, whilst the growth components, being new orders and expectations for business beyond the next month, both rose. So we're in a sweet spot for markets right now, where much of the headwind from inflation is behind us. There are still further declines in inflation to come, but markets are focused on growth. And this is great for multi-asset portfolios. That's all for today. Take care.